We're standing here at the midway point of 2026. But what's next when it comes to the economy? I'm here with the right person to give me all the answers, Cameron Dawson. Cameron, my good friend, so good to see you again. How are you enjoying Florida down here at Edge?
It's absolutely stunning. You can't beat it.
You can't beat it. Beautiful outside, a little humid.
Mildly, yeah, as you can tell.
Right, it's tough on my hair.
Yes,
it's tough on my hair.
You and I both have the same problem.
Yes, very similar, very similar. But something you have all the solutions for. What's going on with this economy?
Yeah.
Where do we stand and what should we be getting ready for?
Yeah, we've been in this incredibly resilient market and economic situation where despite all the worries that people have had that we would see a recession over the course of the last couple of years, this economy has kept continuing to chug along. Just recently we had that strong May jobs print, but the challenge that we have is that it's also coming with hotter inflation, and
Right.
meaning that we're in this world where inflation is just running hotter and stickier than certainly the Fed would like. So I think as we go into the back half of 2026, there's going to be all these debates as to how the new Fed chair is going to handle the situation. You have a relatively resilient economy, a stable unemployment rate, inflation that is above trend and in certain areas certainly accelerating even outside of the energy side of things. And it just suggests that maybe Fed policy won't be nearly as easy or supportive as it once was. The big question though, will the Fed turn adversarial? It's one thing for the Fed to sit on the sidelines and watch the economy do what it does, but does it actually hike rates into this economic backdrop? That's certainly what we'll be listening for at the Fed's June meeting. Absolutely.
And as we sit here, to steal a line from Finding Nemo, just keep swimming, just keep swimming. If we're just going to keep swimming, what can we expect? So much interest in AI, so much interest in those stocks, et cetera. What should we expect as we just keep swimming along here with everything that's happening?
So we've been modifying that just keep swimming and using it for the consumer and being like Dory, which is just keep spending, just keep spending.
Nice.
Because one of the reasons why this economy has remained so resilient, of course, is because consumer spending has remained resilient, even as real wages, which is wages or incomes after inflation, have gone negative. The reason that consumers have been able to keep spending is because of the strong stock market, the wealth effect. The wealth effect has allowed people to dip into their savings. So when we think about tying this into equity markets and how AI is influencing things, we cannot underappreciate just how important this bull market has been for sustaining the US consumer and thus the US economy to get us to that Finding Nemo or Finding Dory point.
Of course, well, if we're talking sequels here, when we look to the second half of this year as a sequel, what can we expect to come here from where we're at to where we're headed?
I wouldn't be surprised if we continue to see a little bit more volatility in the equity markets, just as we're seeing today. The ability for markets to shrug off all the impacts from higher oil prices and uncertainty about the war has really come from the super powered, super normal growth that we are seeing in the semiconductor trade, which of course we know is driven by AI CAPEX and all of the money that the hyperscalers are spending in order to make this AI come to life. The challenge that we have is that markets now got a little bit cheap as we went into the war uncertainty. They've now completely re-rated as we've had a rip-roaring rally coming off of those lows. And so what we're starting to see now is we're hitting a ceiling on some of those valuations, and we're kind of waiting to be able to see if there's still more upside to that hyperscaler CAPEX to drive the next leg of this AI infrastructure cycle. So a great stat to keep in mind is that around this time last year, people were expecting only 10% growth for AI CAPEX from the hyperscalers. Today, that growth expectation is 80% growth for 2026. So that gives you the reason why we've been so resilient. So some of that upside has to kind of keep on going in order to get us propelled to even further highs.
So you made another reference to Pixar. We're going up here, folks. So if we're connecting all those balloons, how are we going to keep going up? What's your big takeaway for folks as we look to keep going up, up, up?
Look, I just hope this market isn't nothing like the first few minutes of up, because that can make any person actively weep.
Yes.
So I do think it all comes down to the ability for the AI trend to continue to be the propeller for this market.
Yes.
Simply because it is the absolute reason why earnings have been so resilient. If you look at the equal weight S&P 500, it is certainly lagged the cap-weighted market on not just a price return basis, but an earnings basis. And that's because the earnings are so concentrated in just this small cohort of AI CapEx beneficiaries. So for us to keep on going up, to fill those helium balloons up, you have to see these hyperscalers willing to continue to up their CapEx spend. And here's the catch with that. They went from spending their own money off of their balance sheets to borrowing money, so spending other people's money with credit, but now they're turning to the equity market in order to fuel this spending. The question is, how much more of that increased equity issuance can this market take as the hyperscalers say, hey, we've already done all of our money spending, let's spend yours.
Absolutely. Well, some incredible insights. You got a friend in me as long as we go, because you roll with the punches no matter what. No matter what I throw at you, you hit it out of the park. Thank you so much for your time today.
I didn't plan on this being Pixar themed, but I love it.
This is the way we go sometimes. Hey, for wealth management, for integrated partners, I'm Matt Ackerman. Have a great day.